Well, thanks for having me comment on the 2013 budget. It was released on Thursday, March 21st, and many believe that this will be the last budget by Jim Flaherty. He is now considered to be one of the longest-running Canadian finance ministers in history. He's certainly not there yet, but he's in the running now. And his budget really sets up Canada for a series of deficits in the coming years. Now, we're hoping to work our way out of deficit and be back to a balanced budget by 2016. And the main focus on the budget was in this sort of arena on jobs and the economy. So what I'd like to do is to highlight today some of the broad-based changes in the budget, and then over the next couple of days, look at some specific targeted measures that finance has used beyond the economy in the budget to increase tax revenue by decreasing what they consider to be loopholes and others would consider to be aggressive tax planning. So we'll look at life insurance one day, and we'll look at small business owner-manager impacts the next day. But for today, let's look at some of the just broad-based changes in the 2013 budget. There were some little things. As an example, they no longer will allow the deduction of the cost for renting a safety deposit box, which I don't think affects too many people. There are some little good things, like they now have a super credit, a temporary super credit, for those making charitable donations for the first time. Now, that's defined as somebody themselves, including their spouses, who haven't made a charitable donation since at least taxation year 2007. And so on the first $1,000 of a donation, the feds are going to offer an additional 25% tax credit, and that will certainly spur a lot of new charitable donations in the coming years. Now, that opportunity is a one-time opportunity, and it will be expiring at the end of taxation year 2018. Well, offsetting that is a continuation of CRA aggressively looking at the use of the charitable donation tax credit for tax planning purposes. There's been a number of schemes and strategies in Canada in the last 10 years that have really pushed the interpretation of this donation tax credit. And so now finance has authorized CRA in this budget to immediately collect up to 50% of the disputed tax interest and penalties on any tax assessments related to charitable giving. Now, this is going to happen even when the taxpayer formally objects, and then you enter into dispute resolution process, which unfortunately can take up to a couple of years. And so finance is given a much bigger stick to CRA to allow them to get 50% of their money up front, and then you fight to get it back down the road. Some other changes: labor-sponsored venture capital corporations are now no longer going to be registered federally, and they are phasing out the ILStv.com tax credit. It's currently at 15%. It'll be phased out by the end of 2016. Another change for farmers is the restricted farm loss deduction, which is currently at $8,750, is doubling to $17,500. Now, this restricted farm loss allows a farmer who has lost money farming to take those losses and use them to deduct against other sources of income. So that's fabulous. They're doubling that. Unfortunately, they're also narrowing down who can use this deduction. So if you're a taxpayer that has other sources of income while you're farming, they're going to make sure that farming is your primary source of income and your other sources are subordinate to farming. So that's going to create a mixed bag of changes that's going to exclude the use of this deduction for many part-time farmers, unfortunately. And then moving to the last two things I'd like to talk about. One is the continuation of CRA's focus on international tax planning, or what they call international tax avoidance. And specifically in this budget, they are looking at non-resident and resident trusts that are used to avoid Canadian tax. So we already have a fairly complex set of rules in the Income Tax Act related to international tax planning. Now in 2013, they're going to tighten up the rules related to residency to figure out where the non-resident trusts are going to be subject to tax. Now, this is just a continuation of an effort to really dissuade Canadian taxpayers from using offshore entities to do tax planning. Now, further, CRA is pledging in this budget that they're going to be continuing to look at any aggressive international tax planning, or what they call treaty shopping, and they'll shut them down real time as they find them. They're also going to be rewarding informants to squeak on people doing international tax planning, and they've gone to an increased environment of transaction disclosure reporting so they can get access to information faster and respond respond quicker on these things. So the era of international tax planning is definitely continuing to wind down with this budget. Finally, and maybe even most significantly, are some changes to mutual funds. For about 10 years now, we've had mutual fund companies using derivatives through a fairly brilliant series of transactions to allow taxpayers on bond funds mostly to convert their fully taxable interest income into only 50% taxable capital gains. So this is called capital gain conversions. And so these products have really flourished in the last 10 years, and this budget comes in and just ends them overnight. No longer are they going to be allowed to use derivatives to convert the taxation for investors on things like interest income to capital gains. And so this will very quickly end a fairly key advantage that many mutual fund companies have had, and the end of that era of capital gain conversions. So we look forward to updating you in the next couple of days on life insurance and small business changes from the federal budget. But for now, my name's Ian Quigley. I'm from Qube Investment Management, and you can follow us at QubeConsulting.ca or on Twitter at Qube Tips. That's all one word.